Yeah, I think it is a trend, and I think that if you look at the venture business, there are a number of venture investors who are investing earlier in the cycle because they don't want to be shut out, right? And this, I'll tell you, this really applies to consumer internet. And it's because if a company starts getting traction and being successful in that respect, right? They start growing the users, etc. The value of that company goes up exponentially. So to get in ahead of that, shift in the curve is really valuable if you're an investor. The problem is that I don't think anyone's particularly good at figuring out, which of those things to get into in advance of information about which ones will be successful.
Entrepreneurs in the, however you want to characterize it, social media, Web 2.0, cloud computing, kind of whatever that broad category is, certainly are raising less money. I don't think there's any doubt about that. Most recent numbers show that the average, first round investment by VCs has dropped significantly over the last 3-4 quarters. And, the reason is that, in a lot of those areas, you don't need all that much money.
The major sources of costs that we were looking at, and things that would have been cost intensive 10 to 15 years ago, like servers, for example, would cost nothing today. And likewise, sales and marketing activities that would have cost tens of thousands of dollars 10 to 15 years ago, you can do for free on Twitter now. So part of it is just a function of, we didn't need to spend that much money, so we didn't go around looking for it. The other dimension of it, I think, is that has to do with the philosophy we were taking, which is emphasizing efficiency, basically just like not asking for more or like looking for more than we actually needed.
A lot of it that you're being charged for is expertise, in certain areas as far as financing and that sort of thing. And we just realized that there was no need for us to sacrifice so much in the beginning because we had the skill set contained within our core group.
9 months ago, it was almost impossible to get funded without a prototype. If you have no startup experience whatsoever, you still really do have to bootstrap it and create a prototype and show some traction before someone will write you a check. That being said, in the last 3 months, that's changing. And people are getting more aggressive. And when I say people, the angel market is crowded. And so people are writing bigger checks at bigger valuations earlier because they want to sort of get into the deal before it happens.
It's completely indistinguishable. I used to talk about how August Capital was the first institutional investor in companies. Well, now there are angel funds like First Round Capital or Soft Tech VC, etc., where they are institutional investors. They've aggregated other people's money and are investing early stage. So that's not the distinction anymore. The amount of money, maybe, except that there are lots of venture investors who are happy to put in $500,000 into a company instead of $2 million, and I've put $500,000 into a company before. So does that, it's in essence an angel investment coming from a venture firm. So I think the distinction is sort of irrelevant.
In general, you're going to see less control by an angel investor than a VC investor. If for no other reason than VCs have to answer to partners and to their own limited partner investors, and so they need to be very rigorous in their approach to companies to make sure that the money's being spent wisely, that the entrepreneurs are focused on the right marketplace, that they're not making mistakes, because at the end of the day, they have to produce a certain return for their investors.
They'll take advantage as far as the entrepreneur will allow themselves to be taken advantage of. And I think that was the big difference between a VC and an angel. And I think because reputation of some of the VCs kind of got skewed, sometimes justly and fairly, sometimes not. But because there was a skewing of their perception, they knew that they had to the joke I made that they had to tape wings and hold a halo over their heads to make themselves look like angels. I think they had to be more amenable to the desires and the ultimate wishes of the entrepreneur. VCs are still VCs, but their actions are more closer to that of an angel now than it was in years past.
There's definitely a temporal shift too. I guess the traditional distinction was that generally angels are much earlier stage. They bring on a lot of they incubate the project in a way, get it
Yeah.
up and going, and then VCs come in, later, usually Series A or something.
Yeah.
And I think what you see now is a lot of big venture capital firms developing seed funding or angel funding,
rounds,
like
yeah.
round, fundings.
Yeah.
And that's an interesting dynamic because again, like they're associated with that behavior, but I think when you put them earlier, like then how do they behave? Because they have to kind of defend and incubate the projects they invest in.
I am not seeing as much of a difference. I think everybody's trying to just get in earlier and earlier and earlier. I also think that there is a overemphasis on understanding the dynamics of fundraising in Silicon Valley and an underemphasis on what really matters, which is building a kick-ass product.